So I am going to touch on a few other things. I'm also going to try to run a bit of a balance between the sole proprietor, which is what most people starting a business start out at, and then I will occasionally allude to the fact that if you're incorporated, it's quite different. So your business would be sole proprietor at this stage in your life, I'm sure. Are you incorporated? Yeah. Okay, so I will have to make sure I balance that, because I mostly kind of talked about sole proprietors. And so we've done our introductions, and I know now that out of the three of you, obviously I'm going to have a wide range of what you know, so I'll just cover it all. And we're going to talk about what a financial statement is. We're going to talk about HST, what the impact is on personal taxes. That's where things get tricky between the two of those types of corporation versus non. A little bit on financing, and actually when you should incorporate, which is something that you can tuck away for some day down the road. So the financial statements themselves are absolutely critical to every business, because what they're telling you is how well your business is actually performing. How much money are you charging to your clients and customers? What are you spending that money on? What's left in your pocket at the end of the day? That's your income statement, profit and loss, same names. And then of course, whatever you have left over after your revenues less what your expenses are is typically what you pay tax on. So that's also very critical, and the government wants to know what that number is. It is accrual based. What the heck does that mean? So accrual based means that you have billed your client for work you did in December. You have not yet been paid, because they will take time and go, okay, yeah, I put it through the system, and they'll pay you in January. You still have to pay taxes. You still have to put that revenue in December, even though that might even be a different year than when you actually get the cash. And that can cause some trouble, but on the other hand, not just the revenue is accrued, so are the expenses. So you've spent all this money putting that project on, together before you could bill them. All of those expenses, you may have put them on your credit card. You don't pay your credit card to January, but you can still expense them to December. So the idea is that you're matching your revenues and expenses for a period. So that's kind of important particularly when you're a builder. The other thing that happens for builders and people in the construction realm of things is that they end up with big projects that aren't done. It doesn't nice and tidy land in the year that you're reporting to the government. And if you have a job that you are partway done, you actually have to go to the trouble of figuring out how much have you earned from this project, how much have you spent on this project, put that in your books, and possibly even set it off to one side in a special account that says, I can't recognize this as revenue yet because I'm not even sure if I'm going to finish the project. I don't know where I'm at. This is work in progress, and it's a very critical part of how you report to the government. So that one, we sit down with our clients quite a bit and say, okay, what is your work in progress? What have you spent in all these materials that you haven't even billed out yet? Don't take all the expenses in this year and all the revenue in next year, because next year you're going to pay me. So we try to match it all up, right? So you're only really paying tax on the profit. So that's the idea of accrual-based, and as I say, for a builder, it can be pretty critical. Your profit and loss does not equate to cash flow. I mean, I already told you that you have to pay tax on what you invoiced in your calendar year or your fiscal year. Because not when you're incorporated, you can have a different year end than December. But that doesn't mean you have the cash in your bank for the money. So you can't look at your profit and loss and say, okay, I made a net of 50,000, and therefore I should have 50,000 in the bank account. Not even remotely close. So you have to watch for the cash. We'll talk about that some more too. And of course, as you probably all know, expenses are assigned to buckets, accounts, categories. All the meals go in one account, all of the travel goes in another, materials and supplies go in one. You keep all the types of expenses in separate buckets. Honestly, does the government care? Not a whole lot about that. It's more for your information. Garbage in, garbage out. If you don't have good information in your books, you can't make decisions. You finished a job and you don't have any idea whether you made money on that job, and now you're going to turn around and quote the next job. What are you basing your quote on? You don't actually know if whatever you quoted last time worked. So it's not just accountants and CRA who care about your books. You should care very, very much about your books. Bob the Builder. I couldn't resist. So this is an income statement, and it's only in 2 sections because of the fact that I couldn't run it, portrait. So we start with the revenues for the year. Bob built a house. And then you have all of your direct costs of goods sold, what you actually spent directly on that job that earned you that money. The job materials for that job, the building costs, the equipment rental, direct labor, like that's your stuff, and then subcontractors. So those people were all directly related to a job and that revenue that you earned, and that's your gross margin. Well, of course, gross margin, it's all well and good, but that's still not what you're taking home at the end of the day. Now we move over here, and your gross margin has all of this overhead. So the overheads are all things that you spent on all your projects for the year. Okay, so they're not specific to a job. That's why they're not in cost of goods sold or cost of sales. So advertising, obviously you wouldn't apply that to a particular job. Bank charges, disposal fees, usually you take a whole bunch of stuff to the dump and it could be several different projects all going into one, so we don't try to allocate that one so much. Fees, memberships for the chamber, plug there if it exists. And also for PKHBA. So, and then you have your insurance, expense on any loans or lines of credit you have, general and admin, some office rents and things like that. Meals and entertainment, we'll talk a little bit about that. Vehicle expenses, your telephone, your cell phone, and your travel. A lot of these have some fairly specific tax rules that you have to be aware of. For example, meals and entertainment. When you are talking about what you are spending as a business expense, you have to kind of be able to prove that you spent that money in order to earn money, right? That's the idea. This is a business expense because I spent it to earn more business income. So, you don't put a bunch of personal expenses in here because you're going to get in trouble. They're going to find you out. They're going to compare your notes to your numbers to all the other numbers they get in. They're going to be like, gee, that person spends a lot of time, a lot of money on meals and entertainment. What the heck are they doing? So the meals and entertainment in particular is one that I love to pick on because you have to be AFK. You guys are young enough to know what AFK is? Away from keyboard? No? So when you're a gamer, that they use AFK, which I think is hilarious because it's not a keyboard, it's a controller, but that's what they use as their I'm stepping away and going to make some dinner. So you're away from your keyboard all day and you are 100 kilometers away, or you're in business meetings, or you can also treat your staff once in a while to something. This is not your Timmies. Do not ever put your Timmies to meals and entertainment. That you may think is absolutely necessary for you to earn business income because coffee, but it is actually not a business expense, it's personal. You should have made your coffee at home and brought it with you. Government does not believe in Timmies and other things like that being a business expense. But if you buy a whole bunch of coffee for the crew, no problem. And you only get to claim half of meals anyway on your taxes. Like regardless of what the purpose of it was, pretty much, there are minor exceptions, you will still only get to write off half of them, which is an interesting little twist. Vehicle expenses, we will show you on the next slide how we calculate those. And then the telephone, that one's also a little tricky. Everybody has a cell phone. Whether you have a business or not, you're gonna have a cell phone. So you can't tell the government that 100% of that cell phone is for business unless you carry 2 cell phones. Which there are people who do that. But generally, you should try to account for the fact that some of that cell phone is personal use if you're being completely, fair and transparent and conservative with our tax team up there in Ottawa. So just so you know. And travel is just planes, trains, hotels. You're going to a conference, you're out of town, that kind of stuff you can put into your travel expenses. But your actual mileage of your vehicle being used for business, that actually goes to vehicle expenses. All right, so that's that one. So hang on, I've done a touch on everything. You will get a copy of these bank charges, fees, and you know how a lot of people will go and they'll build their client and they'll have their phone with them and they stick a square thing in the end of it. There's fees for that. That obviously is a business expense. That goes to bank charges. Yeah, I think I've covered most of it. Insurance, what I have there is more just for business liability. There is life and disability insurance as well, but that actually isn't deductible. It's actually a taxable benefit if your business covers it for you, because it's really for personal stuff. Okay, so I think mostly we've covered everything there. Now let's go back. So, to make sure I covered everything I wanted to. Track your financial activities in a spreadsheet or using bookkeeping software. Be sure to be reasonable as to the expense and business purpose. Keep receipts. PDF is fine. You can scan everything and throw it into OneDrive or Dropbox or anything like that. Just keeping the credit card statement does not work. If you are audited by a CRA, you have to actually have the receipt. Because first of all, from the credit card statement, they can't tell what you bought. It just has the vendor. And second of all, they can't tell how much HST you paid. And if you're going to claim any HST, you have to have that noted. So make sure you keep your receipt, that piece of paper. And then log of vehicle use for business. So this is tricky and also annoying because, I mean, we're busy enough running around running our businesses without having to keep track of how far we drove for business and whether we stopped for groceries on the way home. And so this becomes a bit of a bone of contention for people, particularly the personal tax folks, because they actually have to keep all of the expenses for the vehicle, everything they spent in the year, all the gas, repairs, insurance, all that stuff. And then they have to say, of all of those expenses, some percentage, in my example, 70% of it, was for business driving, and the rest of it was personal. And that's all you can write off then for the year is the 70%. You can claim back also 70% of the HST. We haven't touched on that one too much, but if you are registered. But this is a really difficult and annoying thing to keep track of. When you're a corporation, you don't have to go through all of this nonsense. All you do, you have to keep track of the kilometers you've driven, and then you just charge a corporation an amount per kilometer. So it's a lot easier instead of having to keep track of all of that stuff. You just pay all the expenses personally, and then you turn to your corporation and say, reimburse me for this many kilometers that I drove for my business. And it's a lot more straightforward. But they won't allow that shorthand method for sole proprietors. Okay, that's that one.
Good. Sorry, on that. The basics of if you pay for the vehicle fully up front or something like that, factoring the initial vehicle cost and depreciation.
Yes, that is a completely separate calculation I didn't even touch on, but yes, when you buy, actually, we will touch on it because we're going to the balance sheet next, so we'll talk about that. But yes, there is an allowance for anything you've purchased that has longer value, and that is assets. So your balance sheet then, which is not an area that your average small business spends any time on at all, but it is kind of critical because what it says is, what does your business own? What does your business owe? And what is your business roughly worth? And that can be very critical at some point down the road when you've grown this thing and you're thinking, I'd like to sell it and step away. And so yeah, we'll look at one. So here's Bob. Bob's my husband's name too, so it's always kind of fun to do this. So the balance sheet says that this business has the following assets. It has money in the bank, it has money, accounts receivable is money owed to Bob from a client's work that he did. It has equipment, a vehicle. I didn't bother with depreciation. I'm trying to keep things a little bit simple here. And so this is what the business owns. Easy. This is what the business owes. So at this point in time, tomorrow it'll look different. This point in time, Bob owes somebody $5,000 for some supplies, owes HST to CRA, owes tax to CRA, has a line of credit, a vehicle loan, and has drawn $60,000 out of this business. Again, remembering this is a sole proprietor, so ignore owner's draw when you're a corporation. So, and the net income for the year was 94, and so the balance sheet balances us. Always good. So what you have to think about is these fixed assets then you bought them, the equipment, let's say you bought a dump truck and it's $150,000, you can't expense that all in 1 year. No, it's worth, it has a value for many, many years down the road. In fact, I just had a client who has a balance sheet, and on the balance sheet they had a 1948 International with a hydraulic dump. You are not really at 1948. Okay, I'm sure it's fully depreciated, but it still has value. But they took the expense of that original purchase and they've moved it over several years. So over the years you own something, you depreciate a little every year. And that's how and they're all different types of assets have different rates that you're allowed to use as you write down those. Okay, just so you understand that. What else have I done on here? We talked about that, payable, yes, tax payable, long-term liabilities. Yeah, so remember these long-term liabilities, these lines of credit and interest and vehicle loans, they have interest you're paying to banks or credit companies. And the interest, because these loans were incurred to buy business assets, you can write off the interest you're paying. It's another expense from that income statement, okay? And you can't even use a personal debt. Like if I have a line of credit and I can't get any financing for my business, but I need to buy something for my business and I use my personal line of credit to buy that item for the business, I can write off the interest. You just have to make sure you parse out which part was the business and which part was personal. It's not a problem to use personal debt for business purposes, just to make sure it's clear. And then the owner contributions and draws, this is basically tells you how much money have you to date put in or taken out of the company. In corporations, it's a shareholder loan account that you track that in and out of. So the critical thing is if you're, for example, working with an accountant and you sit down with the accountant and go, okay, here's how much I invoiced my clients, here's all the money I spent, you have to make sure you put the assets over in a separate pile for them, and you have to make sure you put the loans over in a separate pile because they are going on a completely separate statement. So, you know. I will only have this one slide on cash flow because it's pretty critical that we don't ignore the fact that these statements don't reflect much about what happens with cash flow. You know, your money cash in is revenues. You invoiced your client $10,000 plus HST if you are big enough to have been registered, which a lot of people are, especially in construction. The HST that you invoice them isn't yours to keep. So already you've got money sitting in your bank account that isn't yours. You've collected it on behalf of the government. And then, of course, you have monies that have come in from invoices that you issued earlier. So that's your cash in, and then your cash out is expenses plus the HST. You went out and bought a piece of equipment. It was $10,000. You spent HST of $1,300, and so that HST actually you get to have back. So that's another fancy calculation we have to worry about. The software, of course, covers all this for you, so you don't have to worry about it. But you have to be careful about cash. It's possible to be cash poor even when profitable. So if we look back on the balance sheet, I'll go back there in a second, Bob is actually in trouble. And it looks like he pulled out $60,000, he made $90,000, he's got a bunch of assets, he's got a little bit of debt, but it's like, you know, at first glance, you think, what do you mean Bob's in trouble? I mean, he's got some, you know, nice, valuable assets, not fully, I mean, not even 50% covered by debt. And he made some money, took some money out, everything looks great. But the problem is that Bob owes the government 68 grand, 69. And he only has 29,000 in the bank. Where did Bob go wrong? What he did wrong was the last piece of equipment he bought, he didn't finance it. He looked at his bank account and went, I got lots of money, I'll just give him cash. And there's the cash he needed to pay the government. So this is why I always kind of come back to cash and go, if you get a chance to finance something, finance it, because you can actually get yourself in trouble if you buy a long-term asset and use your short-term cash flow. HST, GST. You, I am sure, are HST registered, and so you bill your clients HST, so this is going to be completely old stuff to you. Bethany, I don't imagine you touched on HST much at all. other than you know that when you walk in to buy something and it says the price is $100, you are going to have to come up with $113, and you're like, what the heck is that? Which is what most of us do. So yeah, when you are in business, it's an interesting thing. You collect HST. First of all, you don't have to register for this tax until you're making $30,000 a year. So just until you're there, you don't really have to worry about it. And then every client, after you've registered, you have to add on that 13%, and everything you spend money on, you get the 13% back. So you only send the government the difference. It's a very, very common tax around the world. They call it a value-added tax, and what it really means is that the only people paying tax and not seeing it, it back in their pocket at any level is the end user. So that's what is common in most countries. One of the things I touch on here when I'm talking to people is that you don't have to wait until your business makes $30,000 to register for HST. There are a few reasons why you might want to register early. One is that if you're going to be buying a big piece of equipment and you can get that 13% tax back, can be a lot of cash back in your pocket. If you have a lot of customers who are businesses or people, I don't know, school boards, nonprofits, anybody who is not an individual, they won't really care if you're charging them HST or not, because they're a business, they get it back in some way, shape, or form. If all of your clients are little old ladies, they care about that extra 13% very much. So sometimes my clients will, because they're working mostly with homeowners, they will put off registering for HST because all their cost to their clients is going to pop up 13% overnight, which is hard for some of the smaller clients. And then the third thing is, so I'm at this bullet here, I don't know that this blue is very good to read, and I just had to kind of grab a template this morning, but so consider large purchases, your type of customer, and optics. What do I mean by optics? Ever heard of the expression, fake it till you make it? If you register for HST, everybody assumes you're bigger than you really are. So sometimes it's not a bad way to make your business look like it's really something to be taken seriously, because, hey, I registered for HST, and everybody kind of knows that means you must be fairly successful. And other than that, I think a lot of this is kind of not very pertinent to our discussions today, given the audience, but there are installments that the government also takes from everybody who is earning a certain amount of money. They don't want to wait until you provide a tax return to get their tax. So if you are going to be paying them more than $3,000 in a year, they want you to break that down and give them a quarter every 3 months. Place of supply is really not, again, given our audience here, it's not going to be very critical. Just so you are aware that in Canada, because Canadians don't agree on anything, in 10 provinces and 3 territories, we have not quite 13 different ways of doing sales tax, but pretty close. So if you were to suddenly start doing work in a different province, you have to know what their sales tax rules are. So that's all I really wanted to make sure you were aware of. And if you are in one of the provinces like BC or Saskatchewan, where they don't actually, they have 2 different types of tax, you need to understand the provincial sales tax completely separate from the federal one. So again, just an awareness thing, and it'll help for some folks who might be looking at this later. So personal income tax, when you are a sole proprietor, you put your business activities on your personal tax return. And it is all within that same tax return. It's not a separate tax return at all. It's just a separate schedule, 2125, within your personal taxes. And so you put your revenues in, and of course it's all broken out. I just summarized it here, but your revenues and your cost of goods sold, your gross margin, and all those things go in. If you were running an office, you have your garage full of stuff, which is pretty common in any kind of construction realm. Haven't parked a car in the garage in years because it's full of all this equipment and stuff. So you get to claim part of your home as, really a business use, and so you can deduct that off. We'll talk about that again in a minute. And then you have to take off your income taxes and CPP, and really what you take home at the end of the day would be this 94. So just so you have that. I feel like I made a mistake on something. Anyway, we'll look at it later. So as a sole proprietor, the net income from business is added to all other personal income. Also important, I have a lot of clients who have a full-time job, run a business, evenings or weekends off the side of their desk, and when it starts to make money, it costs them more tax than it would cost somebody who that's all they were doing, because our tax rates are graduated. So if you are already making $50,000, for example, and then you tack another $50,000 from a business on top of that, that extra 50 is going to cost you 30% tax, whereas if it had been in the first 50,000, it would have only cost you about 15. So it's a little painful when you are doing these two things, but at the end of the day, you still have more money in your pocket. But yeah, a lot of people don't account for the amount of tax they're going to have to come up with, which makes it hard. So yeah, sole proprietors pay also CPP. So when you have a regular old job and you get a pay stub every 2 weeks, off of your pay, they take CPP and ER and tax, which is very nice because then the tax is off and it's out of your pocket and you don't spend it by accident. When you're a sole proprietor or any other kind of business for that matter, there's a CPP that needs to be paid and you're the only one paying it. So you end up paying a fair amount into the CPP pool, which you will not see until you are much, much older. and it is very healthy and it will be there, but it does hurt when you have to pay it. It's running 12%. So whatever you've earned, you're handing 12% over to the government for your CPP. So that's hard. And then again, quarterly installments required after tax owing exceeds 3,000, which doesn't take long. And so you have to make sure you set aside some percentage of your earnings into a lot of my clients will put them in a separate savings account. Like they get paid, some client pays them $1,000, and the first thing they do is take 300 of it and plunk it into a savings account because they just don't even want to see it in their account because they'll spend it by accident. I touched briefly on financing. Lenders want to see a business plan, and so if you go through, we were talking about the Starter Company Plus program that Community Futures is now running. The whole point of that program is to help you develop a business plan, so that yes, you get the grant we were talking about, which is lovely, but you're probably going to need more financing than that when you're setting up a brand new business, and that business plan will help you get that financing. There are, of course, difficulties in getting banks to lend you money when you are so new at something they can't tell whether you're going to be successful or be able to pay them back. And for that reason, Community Futures will give loans to people who are pretty untested. So they're also a good resource. Then this is, again, I do tend to repeat myself this, that's the way people learn. Match the financing to the expenditures lifespan. So always finance a fixed asset. If you're buying something big that's going to last 5 years, get a 5-year loan for it. So as much as possible, try to match the life of the asset or somewhere close to it to the loan so that you do not kill your cash flow. Lines of credit, very useful for temporary cash flow problems. You've had to go out and buy a whole bunch of building materials. You don't actually have the money to pay for those yet because you're waiting for your client to pay you maybe an installment. So you use your line of credit, but make sure you pay it back right away. Lines of credit should not be there as a long-term financing technique. So, usually the lines of credit that you get aren't a whole lot of money, and often their interest rates aren't really that great. You could finance over 5 years for a lower interest rate than you would get on a line of credit. Not always, but roughly.
You could convert a line of credit portion to a locked-in.
You could, absolutely. Yeah, sometimes, you get a deal and it's like, oh my God, I want to get this vehicle and I want it now, and you've got the line of credit, so you pay for it, and then you can finance the vehicle later. You can also do lease to own. And capital leases, that's another type of financing you can get. Some of the banks, I know RBC in particular has a whole lease arm, and if you need to buy a piece of equipment, they will help you by actually, literally they buy it and lease it to you, and then at the end of the lease you own it, which is a really interesting technique. But yeah, there's lots of flexibility in that. You just need to have good partners, and that, you know, that's the thing. If you have a business, don't forget the partners. You know, make sure you are with a bank who knows you and you know them, and you can sit down and have that conversation. What's the best thing for me? Have an accountant that understands you and can help give you a bit of advice, and make sure you don't do something that's offside from CRA's point of view. And those supports are really helpful. So, incorporating. Okay, so incorporating is, again, I don't know the rest of the audience for this, but really what it is that you take this small sole proprietor that you started out in your garage and you built it up, and all of a sudden you realize you're paying tax on, I don't know, let's say $75,000 worth of net income, which is costing you with the CPP at least 30%. So you're taking your $75,000 and you're handing over 30% of it to the government. And you're like, I don't know, maybe I should incorporate. And so you look at the idea of taking that business and putting it into a completely new entity. And then that entity as a corporation makes the $75,000, which is great, but that entity pays, and the corporation, by the way, pays tax at only 12%, which sounds really awesome. But how are you getting that money? Like, the money's in the corporation, not in your hands, and you still have to pay your rent. So, you know, you have to balance, how much am I going to take out of the corporation? Because it costs money to incorporate. So you don't want to pay an accountant and a lawyer to create this new entity that you are then going to turn around and pull all the money out of and put it on your personal tax return, because you didn't gain anything. So I sit down with people and we talk about when is the right time to incorporate. And of course, it depends. I have clients who will incorporate at $75,000. I had one the other day who said, anything I'm paying tax over about $40,000, I'm paying too much tax personally, because I am so busy working, I have no time to spend any money. All I need is about $40,000 and I'm happy. So it made sense to incorporate them. They literally live and breathe their business. So this saved them tax, and they were happy about that, and the business will hang on to some of that cash and use it for, you know, future growth of the business and things like that. And they're just going to take out a small amount for themselves. So their personal taxes drop a lot. But, you know, obviously, no matter where the cash is, there's going to be tax on it. It's just trying to balance what's the right setup for you being either a sole proprietor or a corporation. So taxable income and tax rates 12.2% for up to $500,000 of business income after all your expenses, so that's your net income. It's a lot more expensive to set up and maintain. It lives on past the shareholder's life, so that's an interesting one. When you have a corporation and you are the owner of it, you actually are called a shareholder, and if something happens to you, somebody's got to wrap up that corporation, because it still just keeps on going, and look, you know, the government's still looking for tax returns from it. But the really neat thing about a corporation, besides, you know, saving a bit of tax, is that if you are able to build up your business to the point where it actually is independent, sellable, somebody looks at your business and goes, holy cow, you've got a team of employees with a foreman, I guess it's still called foreman, foreperson, and you've got, you know, a lot of really good structure here. You've got a really powerful name, brand, people know your name, and you're thinking, I'd kind of like to exit, and somebody will come along and say, I'd pay for that, because it actually can operate without you doing every last nail and screw. So when you go to sell that corporation, the tax breaks are huge if you can sell the shares of that corporation. So, you know, that's what a lot of people will do. They build up a business, and then they incorporate it, and then they build up the corporation, and then at some point they turn around and they find somebody to buy their shares. And as I say, big tax rate if you can do that. You can sell a business for $1.25 million in 2024 and pay next to no tax. it is very important that we have that, there. But my favorite line is that your business should always be something that you can eventually be independent from. It should be more like a child that will grow up and move out, not like a pet that will never be able to live independently from you. So your business should be growing to independence. That's the goal for most of us. I put in a few resources here, and I will take questions. I think there were only two things I wanted to make sure I didn't forget to say. One was that when you go into business, you want to make sure that you are at least making more than you would if you got a job, because running a business is a stupid amount of work. So that's not to take the shine off of it, but yeah, make sure it's actually going to generate you a decent amount of income. Otherwise, as my husband said in the early days, he's like, why don't you just go get a job? I'm not really sure. Yeah. So that's one thing I wanted to mention. And the other is that I'm just speaking as an accountant. I wanted to make sure you understand that accountants are slammed. Like, they are understaffed, overworked. There's not enough of us. There's a bunch of people retiring. And if you walk in and you aren't organized, and you don't have decent copies of things, and you haven't got a system for your receipts, and you haven't maybe gone into some sort of online bookkeeping platform and started to keep track of things, they will not take you on as a client. They don't need you. They need nice, clean, organized, people who know what they're doing in business. And yeah, clients are being fired by accountants because they just cannot make any money off of you because you're just not organized enough. So I just want to put that out there. It's not a very popular thing to say, but I want to be honest with you, and whoever listens to this later. Okay, questions? Covered everything?
If you, just wondering how you handle assets that you owned maybe for a number of years, and then you go and you start a business using a number of those assets, which could apply to a whole range of areas, of course.
Not a problem at all. It happens a lot. You have to find out what it was worth when you started your business. And so you can go on eBay, or you can go to the Black Book or something and just try, even just do a Google search and see what are people paying for, something similar to that. And as long as you can say, when I moved this asset into my business, it was worth $15,000, then it goes into your books, $15,000 asset, owner contribution, because you contributed something that was owned by you personally, and then that asset is part of your business and you can depreciate it. And that's whether it's a sole proprietor or a corporation.
And that's an expense depreciation.
Yeah, you capitalize it onto the balance sheet and then you depreciate it over a few years, and that's your expense. Yeah. Good question.
And then smaller businesses have different categories of team members, would you say? Mm-hmm. And so one, I guess, employees versus subcontractors.
Yeah.
Can you speak on that a little bit?
Yeah, that's a good question. There's pros and cons to both of them. So an employee is, you have to follow all sorts of employment standards. You have to make sure that they are safe, they are covered by WSIB, well, subs are as well, but anyway. They're typically there for a long time, and you invest in them, and you try to figure out a way to make them maybe a supervisor and work their way up. And an employee in a perfect world is really bought into your business. A subcontractor isn't. I mean, they've got you and a bunch of other clients, and you may or may not get their attention. The subcontract, a lot of people think being a subcontractor is better because you can write off the trips to work, whereas as an employee you can't write off your trip to work. That's just going to work. A subcontractor, their home is their business office, and every client they go to, they can write off, just like I showed you in the vehicle schedule, that trip. And they don't have the EI as a deduction off their pay, but they do have twice the CPP, so it's actually a little more expensive overall. So an employer will often try and, especially if they're really tight on money, they will often try and push people to be a subcontractor, but the subcontractor then has no allegiance to you at all, and so it's plus and minus. The other thing you have to watch out for is if you are working with somebody and they're saying, I'm not going to hire you, I'm just going to take you on as a sub, but I want you here by 9 o'clock in the morning, I want you here 40 hours a week, and you're going to be using this equipment. You're not independent enough to be a subcontractor, and the government will nail that owner. So you have to be really careful as the owner that you're not pushing people into being self-employed when they're really walk like a duck, walk like a down. They look and talk, and everything is like an employee. And then the relationship goes south, and that subcontractor walks into the EI office and says, I really was an employee. They told me everything to do, told me when to go to work, and had no independence, I had no ability to get any other clients whatsoever, and then the guy will come after the owner. So it's better to put them on staff if they are going to be really under your control. Yeah.
And then the subcontractors, depending on their income, will either charge HST or not.
Exactly.
That's the scale.
That's right.
Can you have employees if you are not a corporation?
Oh yes, absolutely. Yeah. I have a number of sole proprietors and partnerships that have a full suite of employees. Yeah, no problem at all.
And that would be, that Service Canada starting a business, probably some more information, but setting up people as employees.
Yeah. When you get into business, you are given a business number. 9 digits, just like a social insurance number, but identifies you as your business. And then what they do is they stick suffixes on the end. So once you open an HST account, it's an RT at the end of that 9 digit. As soon as you open a payroll account because you hired your first employee, it's an RP. So that's how you have all these, one identity. It used to be every one of those had a different number. That was a long time ago. And they got smart and just went with that layout. Now, of course, WSIB is provincial, not federal, so that is a completely different account.
When you say you get the HST back, like everything the business buy, all the HST, you get it back?
Whatever a business buys, you tally up the HST you spent, and you deduct that off of any HST you collect.
You don't know.
You only send them in the difference.
What for youth starting some sort of business regarding in the area, would you recommend certain software that is user friendly enough? It's the main thing.
Yeah, there's a clear winner in the market, and that is QBO, QuickBooks Online. I mean, really, they must have north of 90% of the market, which of course means that if they drop the ball on something, they affect everybody, and they know that you're not going to quit them. So I think they're starting to get a little bit too comfortable. But there are some upstarts that are coming. There are smaller ones like FreshBooks and Zero with an X, and what's the other one? Can't think of it right now. Wave. So there are some smaller online systems like those ones, and for the most part they work not half badly. They're just not quite as robust as QuickBooks, I will have to admit. But the neat thing about them is that they are all online tools. QuickBooks used to be all on a computer, and if you didn't have your computer with you, you couldn't see your books. Now you can have all of your books on QuickBooks Online. It goes on an app on your phone. You can be sitting in the living room having finished the plumbing job, and you make up the invoice and you email it to them, and then they email you the payment, and it's all done on your phone, and it's really, really convenient. Yeah, so that, and then you can invite your accountant or bookkeeper or whatever tax preparer to your QuickBooks Online and Wave and FreshBooks and all those. And so then they can see what you've put in as your bookkeeping, and they can check it over and file taxes for you and things like that. So yeah, it's come a long way in the last few years. All right.
Are there any guidelines similar to the meals and vehicle when it comes to claiming home office, equipment storage expenses, that kind of thing?
Yeah, I mean, anytime you have a bunch of business assets or, things in a storage locker, that the cost of that storage locker is definitely a business expense. That's what it's got in it, you can write it off. In your own home, you have to be a little cautious because if you do not have a clear differentiation between your business taking up part of a room and or a room and all your personal stuff. So an example, I had a client years ago, hubby was a drywaller. She did all of the books, but they didn't have they had kids, so the kids had their bedrooms and they just had a corner of the living room where she kind of said, kids do not walk in here. And she had the desk and she had all of the paperwork for his business there. The auditor from CRA came into the home and said, no, not enough separation because the kids' toys were scattered around the living room. They said, no, it's not a business use. It looks too personal use to me, and he wouldn't allow a business use at home. So I thought that was kind of understandable.
Some drywall samples in the living room.
Yeah.
Or samples before and after.
So I tell clients, if you know the auditors are coming, and they don't just show up, typically, then it would be a really good time to get all of the toys out of the room that you're using for your business office. In construction, of course, like I said before, most of the construction people have their garages full of stuff and they haven't had a car in there in ages, and so it's pretty easy to prove that I cannot enjoy that part of my home because it's being used for business, and then you just mark off what the square footage is as a percentage of the whole footprint, and then you take that percentage of heat, hydro, insurance, mortgage interest, all those.
And it's similar to, I guess, well, you mentioned typically the cell phone is probably estimated somewhere between 50 and 60%
Yeah,
something.
something like that. I've gone as high as 90, but I don't usually take 100. Unless they have two different phones, which
Right.
is a bit of a nuisance. But yeah, and it does depend on the CRA auditor. I had one fellow who had all sorts of problems with the auditor, who said, well, you'd have a phone anyway, so I'm only gonna allow the incremental. How many long distance phone calls did you make for your business? Those guys are rare. Like that was just mean. But I figure as long as you're not trying to push too hard, then you won't get one of those slam people. So nope, not allowing anything. So we normally